welcome to this week's edition of MFB News. I hope you're all really good. The sun is blazing in through the window there. It's looking like it's going to be a beautiful day, and today is Wednesday, incidentally. Is the news going to be quite so bright and sunny in terms of interest rates? We'll come to that in a moment. So yeah, in terms of what we're going to go through with you today on that note, we're going to go through what's been happening with swap rates, give you some context around what's going on there. We're going to talk about how that's impacted lender pricing, give you any updates on lending criteria. Then we're going to talk about rents and what's going on in terms of rental yields, according to a report from one of the UK's large buy-to-let lenders. And then finally, we're going to wrap up with a deep dive into the Paragon Portfolio Landlord Report for 2024. And this is a really good opportunity for those of you who are like myself, a bit nosy and want to know what other landlords are up to, because it's not something that you could easily find out. I always say this, but you know, when you're a landlord, you're working by yourself. You don't necessarily have a whole network of other landlords that you can just chat to. So this report, we're going to deep dive into what landlords are up to, what they have and what their plans are as well, to give you a feel about what your peers are actually up to. Interest rates, and I'm going to start off this segment by saying please don't shoot the messenger. Now, as we know, there is a lot of escalating tension in between Iran and Israel, which is causing a lot of nervousness. Also, the Fed has reacted to the American CPI data, and on the back of these two things and also the continued wage growth situation, there's a lot of nervousness in the capital markets about whether the Bank of England will be able to actually make reductions to base rate. And some people were predicting as early as June, or, you know, whether it's going to be kicked out further. And I think the general consensus is that actually, in light of all the different things that are going on, June probably feels quite soon to be reducing base rate because of the reasons that I've talked about. There's a nervousness around inflation and how that's going to perform. And also the UK are clearly watching what's going on in America and also China as well. So actually it's becoming less likely that base rate will indeed come down in June. And so the capital markets are reacting to this. And that's essentially what's driving the behaviour with swap rates, which in turn is making or filtering through and impacting mortgage rates. So essentially what's going on is that swap rates have increased in the last week. That's the bit that I didn't want to say out to you, but that's what's been going on. 2-year swap rates 4.591, 1 month ago 4.501. So we're up by a sort of almost 0.1%, which sounds like not a lot, but actually in between 1 month ago and now things have actually come down further. So the step up's actually much more significant. 5-year swaps have gone over the 4% mark. I don't know if those of you who watched this, you know that I was desperate to get them below 4%, and we got down to 3.6 something, I think was the lowest. 5-year swaps as of this morning are at 4.073. 1 month ago 3.937, but like I say, they did a further dip in between now and 1 month ago. So, you know, essentially the cost of funds are increasing for lenders at the moment. There's a lot of nervousness in the market. The lenders are always going to react to the cost of funds because that's what the money costs them to then lend it back out to you, and they have to make a profit on top. So if their costs go up, their interest rates, their mortgage rates have to increase. And because there's a lot of nervousness and uncertainty and things are bouncing around, so we're back to a more volatile period with swap rates now, lenders have two choices. They can either pull their rates and not reprice until things come down, which means they have no deals on the market, and a couple of lenders have made that decision at the moment. The other option is that you can reprice, but rather than kind of going in exactly the margin that you need above your cost of funds on the given day, you're going to add a bit more to give you some flexibility to allow for volatility in the market, which means that actually the mortgage, it becomes essentially a bit more expensive than maybe it would have to be. So that's kind of what's going on right now. So in terms of lender pricing, we have seen a bit of changing in the last week, but actually I suspect we're going to see more going on over the next few days. So first of all, we've seen Landbay increase all of their rates by 0.2%. We've seen the Leeds increase their rates by up to 0.5%. Now, what I would say here is this is for their limited company offering, which was really like standout competitive. So I think for this, it's actually for them, this is more about driving down business volumes. The Leeds aren't particularly a huge lender, and they would have been getting absolutely swamped because the rates were really good. So I think the increase in rates here is just about kind of driving down business volumes than anything else. They have actually incidentally reduced their standard rates by 0.15%. So this just feels more like tinkering to me in terms of kind of controlling business volumes. Now, Santander actually incidentally has also dropped their rates, their fixed rates, and they've also introduced some trackers which are starting from 5.69%. Now, with these two lenders, like I say, dropping rates down, I wouldn't read into this. It's not like they have a different funding model to everybody else, every other lender in the UK. These guys, well, they do take deposit monies, and obviously base rates stay the same. So the kind of bit that they rely on, in very kind of simple terms, the money they're lending back out, which is linked to savings accounts, that cost hasn't changed. But they will also always have some exposure to the capital market. So no lender lends, as far as I'm aware, entirely off of balance sheet, but some lenders do lend entirely off of capital markets. So different funding models, and that's why I think the high street lenders who do take savers money in can have some flexibility around the rates. Now, we've seen Aldermore remove all of their rates bar their limited editions. This is one of the lenders now who's pulled products and hasn't brought any back on because they're waiting for things to settle down. So Aldermore only currently have a tiny little selection of rates, which are their limited editions. Conversely, the Yorkshire Building Society have reduced buy-to-let and semi-commercial rates by 0.2%, and they've also introduced a tracker. Now, actually, last night what we saw is another handful of lenders announced that they're going to be pulling rates. So Paragon are making withdrawals, Keystone as well, just to name a couple, and we'll sort of fill you back in on those next week because I don't have kind of the formal announcements for all of these lenders. But really what we're now expecting is a busy week in terms of lenders pulling deals. So what can you do to protect yourself in this situation? Get your applications in. That's the absolute thing. So once you've submitted an application in full, and it's not a decision in principle, that's not strictly true. Some lenders, when you do a decision in principle, that will book the mortgage interest rate for a period of days. And it is only days, right? It's like 2 weeks tops. But actually, to really secure the interest rate, you need to have submitted your mortgage application. That would include paying any fees that are due. So, for example, application fees or valuation fees. So if you are kind of sitting there thinking about taking a rate, waiting for interest rates to come down, my advice to you is just get on with it, book the rate because things are starting to increase. But the good news is, as we talked about many times before, for most lenders, and do check this, for the lender that you're thinking about, but most lenders, if before you complete on the mortgage, they do drop their rates down, they will let you transfer onto a new lower product. They might charge you a small admin fee, but invariably this will be kind of saved back with the reduction in interest rates. Now, there's the good news, or not good news as it were, in terms of what you can do to kind of protect your position with mortgage rates. And I think really we're just going to have to kind of watch this space. I've just seen come through on my phone, it's 7 o'clock in the morning, the BBC notification that inflation has fallen to 3.2%. So there is some kind of good news in the ether as well. But like I say, I think the concern is really, is this kind of reduction in inflation going to be able to continue given the kind of broader situation? Okay, so enough of interest rates today. One new bit of lending criteria, United Trust Bank. So they are now allowing, or accepting rather, new build properties. They're allowing purchases off plan. The key point being here that when the valuer goes out for the properties that finish, which often with off-plan properties, I mean, they're not even sort of built, they're just a bit of a plan and some, holes in the ground. They would want to re-inspect the property for completion, which is very standard. They will accept up to 5% incentives from the developer. And that can include deposits actually. So if the developer's saying, I'll pay you a 5% sort of contribution towards your deposit, United Trust Bank can accept this. And as you would expect, they are going to be requesting an appropriate, evidence of appropriate new build warranty or certificate. So good to see United Trust moving into the new build property sector this week. Okay, now a quick bit on rental yields. The Fleet Mortgages have released their latest Rental Barometer Report, which makes some very good reading. And so the kind of key highlights from this report that I wanted to share, and I think I'm just doing this to kind of offset the news about swap rates, if I'm honest. The total average yield for England and Wales shows an annual increase again by up 0.4%. So the average yield now is 7.1%, which is an increase of 0.4% on the same quarter in 2023. This is also up by 0.2% on the quarter four figures of 2023, which was 6.9. So essentially, compared to the previous quarter, rents have increased by 0.2%, and year on year they've increased by 0.4%. Average yield in the UK is now sitting at 7.1%. Dear God, I wish Sevenoaks attracted those kinds of yields where I had my buy-to-lets. I think we're down to like 3% or something. So what they're saying here is that actually every region of England and Wales has seen an increase bar one, and that is the northeast, which has seen annual yield increases. However, it's year-on-year drop of 0.4%, and that's the kind of key thing here. Does not stop it from featuring in second place with an average rental yield of 8.4%. So northeast isn't seeing the same level of rental yield increases compared to the UK average, but actually what it has done is still sat second from the top in terms of the yields that it is achieving. Now, what they're saying is that there is still very much a strong north-south divide, with all top regions being in the north, so Yorkshire and Humberside, the northeast and northwest, with the the Midlands and Wales in the middle, followed by the southern regions. And Yorkshire and Humberside have jumped to the top spot above the northeast, which has tended to be the #1 region for most of the rental barometer iterations. So Yorkshire and Humberside is currently the highest generating region in terms of rental yields. Last quarter, Wales had the highest average rental yield, but it's fallen back to 5th in the table, with a notable increase of 0.6% for the West Midlands, as well as East Anglia and Greater London. So I think in the round, very, very positive, and with mortgage rates kind of being where they are, an increase in rental yields is going to kind of help ameliorate the increased costs that landlords are facing. And hopefully, if you are thinking about investing this year and you're really kind of yield driven, and actually this is an interesting thing to kind of point out. So most of the phone calls that I'm taking at the moment from landlords are saying, I just need to drive up the income across the portfolio at the moment, because I'm feeling really kind of stretched in terms of cash flow. So one thing is diversification. So moving away from kind of, 2-bedroom flats into things like HMOs and multi-units, which are traditionally the higher yielding assets. But the other thing might be to reconsider the locations in which you're investing. If you want to drive up yield, then clearly, the message is very, very clear. And this isn't just from this report, it's across all reports. If yield is your thing, then you need to be looking in the north of the country. Okay, so time to be nosy, find out what everyone's up to. So Paragon have released their portfolio landlord report, where they've gone out and spent probably huge amounts of money, if I'm honest, surveying lots and lots of landlords and kind of finding out what they're up to and how they're feeling and all this kind of stuff. It's really, really interesting report, actually. And I'm going to share with you the key points. So the first kind of thing to note is that of the people that have responded to the survey, 80% have a portfolio which is purely residential property, with 20% having a mixture of residential and commercial. 44% of respondents had between 5 and 10 properties, 16% had 11 to 15, so that's 60% in total have between 5 and 15 properties, and the remainder of the respondents kind of sat either side of that. So we're talking about landlords who have some quite chunky portfolios here. And of those respondents, 1/3 of them are holding properties in a mixture of limited company and personal. The remainder, so the other 2/3, is kind of split rather evenly actually, either all personal or all limited company. So a real mixture of ownership going on there as well. Now, in terms of the most popular tenant types amongst the respondents, it turns out that most landlords seem to prefer letting to families and young couples, with the least popular tenant types being migrant workers and corporate lets. Now, when looking to invest, the respondents were saying their key motivations were capital growth and making provision for a pension, essentially. Least kind of biggest motivators, that was terrible English, sorry, are forging a desirable career, and also for those people who've inherited property and decided to rent it out. In terms of most popular property types, so landlords responding to this survey love terrace homes and they love semi-detached houses. Their least favourite property types are bungalows and maisonettes. And when asked if they prefer to buy a ready-made property or a doer-upper, 55% prefer something which is either in need of either minor works or major refurbishments. 32% of respondents actually didn't mind, so just 13% of landlords who are investing from this pool of landlords, as it were, only are looking for particularly ready-made properties to rent out, which I found quite surprising actually. Anyway, in terms of landlord confidence, the landlord confidence in tenant demand, 93% of respondents are feeling positive about this, but only 39% of respondents are confident in the broader PRS. 10% are confident in the economy, and just 6% are confident in the political landscape at the moment. Now, in terms of future plans, 37% of respondents are planning to buy a property, 21% are planning on decreasing, and just 2% are planning to exit the market entirely. So a very, very small number of landlords who are planning to kind of entirely leave the market. Now, in terms of EPCs, so 69% of landlords who responded already have an EPC of C or above, or are planning to continue to make improvements to get to a C over the next few years, even though the plan changes to EPCs have been postponed. Now, in terms of the largest challenges that your peers are facing in their portfolios at the moment, so 37% are saying late rent payments, 30% are saying arrears, And moving down to the kind of bottom of the list in terms of challenges, so antisocial behaviour. So 12% of landlords have experienced antisocial behaviour, and 7% have experienced damage to property by pets. In terms of average times to evict tenants, and for those of you who watch this video, you'll know that's a subject very close to my heart. 53% of evictions are taking between 3 and 6 months, and 11% are taking over 12 months, and that was the camp that I fell into. So as we can see, it's still a very, very long and drawn out and expensive process for landlords to get those tenants out, which really just reinforces the message that the court system is not fit for purpose at the moment. And finally, in terms of what landlords do with rents and putting them up. So 41% of landlords just increase rents annually. I think most of them haven't written the contract and they just reinforce it as a kind of matter of course. 20% say that they just increase rents every few years, and 21% are increasing their rents when prompted by rising costs. So there you go. I thought that was really, really interesting. I do have the report if you would like a copy of it. It's quite long, but it's very interesting, and it's kind of prepared in a way that's very, very easy to digest. Do email in. We'll be very, very happy to share this with you, but I hope you found that interesting. And that's be done for this week. So thank you as always for joining us. I hope you found that useful. I know I keep threatening to do a question of the week, but there just seems to be so much other chunky stuff to talk to you about. So hopefully we'll bring that back in next week. Also next week we'll be talking about how the inflation news has impacted the markets and what that actually means for you, and kind of just do a kind of roundup in terms of where things are going with swap rates. I know there's so many people at the moment who are just holding on, waiting for rates to soften. There's people who went onto the variable rate, acting in what I would see as good faith because they'd heard rates were going to come down. This has just been postponed and postponed, and so these guys are paying eye-watering interest rates of 9.5%, 10%. So, you know, just timing I think is becoming absolutely critical for people. So until then, do have a lovely, lovely week and lovely weekend. And if you have any questions, you know, you can give us a call, 0345 345 6788. I will see you again same time next week.